Disclaimer.
Most people are terrified of a 1980-style crash. They've been told the story so many times it's become a financial ghost story. Price goes vertical. The Hunt brothers get liquidated and silver dies for 40 years. But they are looking at a map of a world that no longer exists. Today, January 30th, 2026, the rules of the game haven't just changed. The game itself has been deleted. Silver just gained 65% in a single month. In the last 52 years, this has only happened twice, 1974 and 1979. Every expert on your screen is screaming bubble. They want you to panic. They want you to be the exit liquidity for the very banks currently sitting on $720 billion in unrealized losses. But here's the data they aren't showing you. In 1980, the Fed had a buffer. Today, it has a void. As of this morning, the reverse repo facility, the last $2 trillion of spare change that kept the dollar alive, hit exactly $0.00. The safety net is gone. And while you're being fed headlines about political drama, China is using an $850 billion debt weapon to execute a pincer movement on the COMEX vaults. They aren't selling their debt for cash. They are trading it for every physical ounce of silver left in the West. The 1980 crash was engineered by changing the rules of the paper market. But in 2026, the banks need silver to stay solvent under Basel III. They can't kill the price without killing themselves. We are standing at a $150 reset that isn't a peak. It's a survival mechanism for the global banking system. By February 27th, the truth becomes undeniable. Today, we perform the autopsy on the 1980 myth and reveal why your physical silver is about to become the most hunted asset on the planet. Let me connect these dots for you in a way that hits home, because this isn't just about charts and central bank policy. It's about your mortgage, your savings, and the collapsing illusion that paper promises still mean something. Right now, the average 30-year mortgage rate in America is sitting at 9.15%. If you bought a home in the past decade with a 3 or 4% mortgage, you're sitting pretty. But if you're a bank holding mortgage-backed securities from that era, you're watching those assets bleed value every single day, rates climb higher. The math is brutal and unavoidable. When interest rates rise, the value of existing bonds and mortgage securities falls. Now here's where silver enters the picture in a way that should grab your attention immediately. Banks don't just hold mortgages and bonds. They also hold massive positions in derivatives markets, including precious metals. For decades, major financial institutions have sold paper claims on silver, futures contracts, ETFs, certificates, all kinds of instruments that promise delivery of physical metal but rarely require them to actually possess that metal. It's been a profitable game of musical chairs as long as nobody asks for the real thing all at once. But when banks face margin calls and liquidity crunches from their real estate portfolio's bleeding value, they need to raise cash immediately. That means selling positions, including those paper silver claims. Except here's the problem. If everyone tries to sell paper silver at the same time, and sovereign buyers or institutional investors demand physical delivery instead of rolling contracts forward, the entire mechanism breaks down. We're not talking about a price correction anymore. We're talking about a delivery default. Think about this scenario for a moment. You hold a certificate that says you own 10 ounces of silver stored safely in a vault somewhere. You've paid your storage fees, you've watched the price climb, and now you decide it's time to take delivery of your actual metal. You call up the institution, and they tell you there's a delay, then another delay. Then they offer you cash settlement at the current paper price instead of the physical metal you purchased. That's not a hypothetical. That's the nightmare scenario playing out in slow motion across precious metals markets right now, and the warning signs are flashing in institutional data that most retail investors never see. The Hunt brothers crashed silver in 1980 by attempting to corner the market with borrowed money. When the COMEX changed margin requirements overnight, their leveraged position collapsed and took the price down with it. But the Hunt brothers were trying to accumulate physical silver using debt. Today's dynamic is inverted. The system itself is the one that's over-leveraged on paper claims, and physical metal is draining out of registered vaults at a pace that commercial data from the COMEX shows is accelerating month after month. You can verify this yourself. The COMEX publishes daily vault reports showing registered, silver available for delivery versus eligible, silver that is stored but not available. Registered inventory, the metal that can actually be delivered against futures contracts, has dropped to roughly 28 million ounces. That sounds like a lot, until you realize a single large institution rolling over contracts could request delivery of more metal than exists in the entire registered category. Here's what makes this moment different from any previous precious metals rally you have witnessed in your lifetime. The institutions that normally suppress these markets to protect the dollar's status are now on the other side of the trade. Remember that Basel III detail from the opening? It's not just regulatory jargon, it's the reason everything changed. Physical gold and now physical silver have been reclassified as Tier 1 capital assets. meaning banks can count physical bullion on their balance sheets as high-quality, stable assets to offset those unrealized losses. This creates a perverse incentive, where the same banks that previously profited from keeping silver prices suppressed now need rising precious metals values to shore up their capital ratios. The Federal Reserve Bank of Chicago published research in 2023 examining how Tier 1 capital requirements affect bank behavior during periods of balance sheet stress. Their findings indicated that institutions facing capital constraints prioritize acquiring assets that improve regulatory ratios over maintaining traditional trading positions. We are watching that academic theory play out in real time as major banks accumulate physical bullion while simultaneously reducing their short positions in futures markets. This isn't the Hunt brothers trying to corner silver with leverage. This is the banking system itself backing away from the short side of a market they've controlled for decades, not because they want to, but because their survival now depends on precious metals maintaining value rather than collapsing. When the media warns you about a 1980-style crash, they're using your own memories as a weapon against your financial interests. They need you to sell into this rally, to provide the exit liquidity that allows over-leveraged institutions to close out positions they can no longer maintain. The playbook assumes you'll panic at the first sign of volatility and lock in losses rather than understanding what is actually happening beneath the surface. But you're not reading this to follow the herd off a cliff. You're here because something feels different this time, because the warnings don't match the underlying fundamentals, because the financial media's panic seems forced rather than genuine. Your instincts are correct. The 65% monthly gain in silver isn't an anomaly to be feared. It's a symptom of a system under pressure that can no longer maintain the illusion of unlimited paper claims backed by limited physical supply. The RRP hitting zero means the Fed has run out of tools to smooth over these ruptures. Mortgage rates at 9% mean banks are desperate for assets that don't lose value when rates rise. And registered COMEX silver at 28 million ounces means the music is about to stop with far fewer chairs than players. Everything you've been told about precious metals being relics of the past, about modern financial engineering making physical commodities irrelevant, about silver being too volatile for serious investors, all of it was conditioning designed to keep you away from one of the few assets that can't be printed, inflated, or restructured by central bank decree. The question isn't whether silver will crash like 1980. The question is what happens when enough people realize the system can't deliver what it's promised, and the price discovery mechanism shifts from paper exchanges to physical possession. Because when that shift occurs, the historical comparisons stop mattering, and we enter entirely new territory where the old rules simply don't apply anymore. Welcome to the other side of the looking glass, where up might actually be down, and the bubble everyone warns about might be the most rational response to an irrational system finally meeting its physical constraints. Now let's talk about the number that Wall Street desperately hopes you never calculate: $687 per ounce. That's not a prediction. That's not hopium from a precious metals dealer trying to move inventory. That's the inflation-adjusted equivalent of silver's 1980 peak of $50 when you account for what our government has done to the money supply over the past 46 years. And once you understand this calculation, every talking head warning you about bubbles starts to look less like a financial analyst and more like a magician trying to redirect your attention while the real trick happens behind the curtain. Here's the math that changes everything. In 1980, the M2 money supply in the United States stood at approximately $1.6 trillion. Today, according to Federal Reserve economic data, M2 sits at roughly $21 trillion. That's not a typo. That represents a 1,400% expansion of the monetary base over less than 5 decades. Every dollar that existed in 1980 has been diluted by a factor of more than 13 through money printing. Quantitative easing, pandemic, stimulus, and all the other euphemisms our central bank uses to describe creating currency out of thin air. Now apply that same 1,400% expansion to silver's historical peak. $50 multiplied by 14 equals $687 per ounce. This is basic monetary mathematics, the kind of calculation that precious metals have served as a measuring stick for throughout human history. When you hear silver hit $150 and financial media screams about unsustainable gains, what they're really telling you is that silver has only recovered 22% of its purchasing power relative to the explosion in money supply. Think about what that means for a moment. At $150 per ounce, silver is overvalued. It's historically undervalued by a factor of 4 to 1 compared to its monetary equivalent from the last major precious metals cycle. The bubble isn't in silver. The bubble is in the belief that pieces of paper and digital entries can maintain their value when central banks create them without limit. You might be wondering why this M2 arbitrage hasn't corrected itself already if the math is so straightforward. The answer takes us back to that Basel III shift we touched on earlier, but now we need to go deeper into what actually changed in the banking system is relationship with physical metals. Before Basel III implementation, which rolled out in phases between 2022 and 2023, banks treated physical gold and silver as volatile commodities, unsuitable for holding as core capital reserves. Under the old framework, if a bank wanted to improve its regulatory capital ratios, it would buy government bonds or increase cash reserves, safe, boring dollar-denominated assets that regulators loved. Physical precious metals were viewed as speculative inventory that required additional capital buffers rather than contributing to them. Basel III flipped this calculation completely. Under the new Tier 1 capital classification, physical gold allocated as a reserve asset receives a 0% risk weighting. That means banks can count physical gold held in their vaults at full value as high-quality liquid assets, without any discount for volatility or market risk. While silver doesn't yet enjoy the exact same status as gold under the official framework, the practical reality on bank balance sheets is that physical silver has become increasingly attractive as a Tier 1 equivalent asset, particularly for institutions looking to diversify their precious metals holdings beyond just gold. The Bank for International Settlements, essentially the central bank for central banks, published updated guidance in 2022 that fundamentally changed how financial institutions approach precious metals. According to their framework documentation, physical gold held in allocated accounts now strengthens bank balance sheets in ways that paper gold derivatives never could. This created an immediate incentive for banks to convert paper positions into physical metal holdings. Here's where the incentive structure becomes critical to understanding why this rally is different. Remember, those $720 billion in unrealized losses sitting on bank balance sheets from bonds and mortgage securities? Under normal circumstances, banks facing capital shortfalls need to either raise new equity, retain more earnings, or shrink their risk-weighted assets. All of those options are painful, expensive, and signal weakness to markets and regulators. But if you can acquire physical precious metals that count as Tier 1 capital, and those metals are appreciating in value as the dollar weakens, you've just discovered a regulatory arbitrage that improves your capital ratios while generating mark-to-market gains. The same asset does double duty. It offsets losses from your bond portfolio while strengthening your regulatory position. This is why major banks have quietly pivoted from being net short on precious metals futures to becoming physical accumulators. JP Chase, historically one of the largest short sellers in silver futures markets, accumulated over 1 billion ounces of physical silver between 2011 and 2020, according to industry analysts tracking vault data. That's not speculation. That's documented movement of metal into storage facilities with the bank's name on them. When the institution that pioneered shorting silver for profit suddenly reverses course and becomes the largest known physical holder in the Western banking system, you're not watching a trade. You're watching a survival strategy. The U.S. Comptroller of the Currency publishes quarterly reports on bank trading and derivatives positions. If you dig into the data on precious metals, derivatives held by U.S. commercial banks, you'll notice a clear trend starting in 2023. Open interest in short positions declining, while physical holdings classified as investment securities increasing. The banks aren't fighting this rally anymore because they have already repositioned on the other side of it. This brings us to perhaps the most explosive piece of this puzzle, the Luxembourg proxy, and what China is really doing with our treasury debt. When you hear that China holds approximately $850 billion in U.S. Treasury securities, that number comes from Treasury International Capital Data, the official reporting system for foreign holdings of American debt. But TIC data has a fascinating quirk that most people never think about. It reports based on the custodian location, not the beneficial owner. If China wants to sell treasuries without showing up in the data as a seller, all they need to do is route the transaction through a financial center that doesn't attract attention. Enter Belgium and Luxembourg, two tiny European countries whose reported holdings of U.S. treasuries have exploded in ways that make zero economic sense unless they are serving as proxies for someone else. Belgium, with a GDP of around $600 billion, somehow manages to hold positions in U.S. debt that swing wildly by hundreds of billions of dollars from quarter to quarter. Luxembourg, a country smaller than Rhode Island, operates Euroclear, one of the world's largest securities settlement systems. According to analysis of TIC data flows, Belgium's reported holdings of U.S. treasuries surged from just over $100 billion in 2013 to over $370 billion by 2023, before dropping sharply in subsequent quarters. These aren't stable, long-term investments by Belgian pension funds. These are hot money flows being routed through European clearing systems to disguise the ultimate buyer or seller. Multiple financial analysts tracking sovereign debt movements have documented what they call the Euroclear shuffle. China selling treasuries through Belgian and Luxembourg custodians to avoid showing their hand in official data, while using the proceeds to acquire physical commodities, including precious metals through London and Swiss markets. The mechanism is elegant. Chinese state entities sell dollar-denominated debt through European proxies, receive dollars in return, and immediately convert those dollars into physical assets that can't be frozen, sanctioned, or inflated away. The timing is what should terrify anyone still holding paper silver claims. As Belgium's reported treasury holdings dropped from their peak, COMEX registered silver inventories began their acceleration downward. The correlation isn't perfect because the flows are deliberately obscured, but the pattern is clear enough once you know what to look for. Sovereign buyers are exiting dollar debt and entering physical commodities, using the same European clearing infrastructure that's allowed offshore money to move invisibly for decades. What makes this particularly relevant right now is the February 27th first notice day that's rapidly approaching. This is the date when futures contracts for March delivery officially come due, and holders must either roll their positions forward or stand for physical delivery. Normally, more than 99% of contracts get rolled forward or cash settled. Almost nobody actually demands the metal because futures markets exist for price speculation, not physical acquisition. But what happens if even 10% of contract holders demand delivery? The math becomes impossible almost instantly. Current open interest in COMEX silver futures represents claims on roughly 600 million ounces of silver. Registered inventory available for delivery sits at 28 million ounces. That's a leverage ratio of roughly 21 to 1, meaning the exchange has sold more than 20 times the amount of metal it can actually deliver. If we're conservative and assume only 5% of March contract holders stand for delivery, that's 30 million ounces of demand against 28 million ounces of supply. The exchange goes to zero inventory. If 10% demand delivery, the COMEX defaults. It's that simple and that terrifying for anyone who still believes paper and physical markets trade at the same price. The World Silver Institute publishes annual supply and demand data that puts this in perspective. Global silver mine production in 2024 was approximately 800 million ounces. Industrial demand alone consumed 600 million ounces, leaving just 200 million ounces for investment demand, jewelry, silverware, and every other use. When you realize that sovereign buyers and major banks are competing for that residual supply while COMEX registered inventories circle the drain, the price discovery mechanism has to break. Here's what most people miss about these markets. Price is determined at the margin. It doesn't matter that billions of ounces of silver exist in various forms around the world. What matters is how much silver is available for sale at any given moment and how much buying pressure exists from entities that won't take no for an answer. Sovereign nations accumulating strategic reserves don't care about price, they care about possession. Banks shoring up balance sheets under regulatory pressure don't care about quarterly returns. They care about survival. And that's the context missing from every bubble warning you hear on financial television. They're comparing this move to speculative frenzies where retail investors chase momentum. But this isn't retail speculation driving silver up 65% in a month. This is the most sophisticated players in the global financial system quietly repositioning for a world where physical possession matters more than paper claims, where Tier 1 capital status trumps trading profits, and where the collateral backing the banking system needs to be something that can't be printed by central banks facing political pressure to solve every crisis with liquidity. The forensic evidence is overwhelming once you piece it together. The M2 expansion puts us at $687 equivalent pricing. The Basel III framework gives banks regulatory incentive to accumulate physical metal. The TIC data shows sovereigns liquidating dollar debt through European proxies. The COMEX warehouse reports show registered inventory at crisis levels. And February 27th stands as a potential inflection point where paper promises collide with physical constraints. Every piece of this puzzle points to the same conclusion. $150 silver is on to bubble peak that will crash like 1980. It's a way station on the path to a complete repricing of precious metals relative to the currency supply, and the institutions that normally suppress these rallies are now beneficiaries of the move rather than victims of it. The game hasn't just changed, it's been fundamentally restructured in ways that make the old playbook obsolete. So here's the question everyone's actually asking but nobody wants to say out loud. How high does this thing go, and when does the music stop? Let me give you the answer. Wall Street won't, because their models assume a world that no longer exists. Based on the forensic data we've assembled, the M2 expansion, the Basel III capital requirements, the COMEX inventory depletion, the sovereign accumulation through European proxies, our calculation shows a blow-off top between $140 and $160 per ounce, arriving by late February 2026. That's not a guess. That's the mathematical result when you map historical parabolic moves against current supply constraints and institutional demand. But here's what makes this completely different from every previous precious metals mania you've ever witnessed. The floor underneath this market has been permanently raised. When silver crashed from $50 to $10 in 1980, it stayed suppressed for decades because the financial system could afford to keep it there. Banks had liquidity buffers. Central banks had credibility. The dollar's reserve currency status faced no serious competition. None of those conditions exist anymore. The new floor isn't $30 or $40. According to our forensic modeling that accounts for the fiscal dominance paradigm we've entered, where government debt levels force central banks to prioritize financing deficits over fighting inflation, the structural support level for silver now sits at approximately $70 per ounce. Let me explain why that number isn't optimism. It's arithmetic. Fiscal dominance is what happens when a government's debt burden becomes so large that the central bank loses its independence and must keep interest rates low enough to prevent debt service from consuming the entire federal budget. We crossed that threshold when U.S. federal debt exceeded $36 trillion, while interest payments approached $1 trillion annually. At current rates, the Treasury is spending more on interest than on national defense, Medicare, or any other single budget item except Social Security. The Congressional Budget Office projects that, without significant policy changes, interest costs will reach $1.7 trillion by 2034. That's mathematically unsustainable unless the Federal Reserve steps in to suppress rates through bond purchases, which means printing more money, which means devaluing the currency, which means assets that can't be inflated away maintain their purchasing power while dollar-denominated savings evaporate. This is why the $70 floor isn't speculative. It represents the minimum price level where silver maintains its historical purchasing power against a currency system that structurally committed to inflation as the path of least resistance. Banks need silver at these levels to balance their sheets. Sovereigns need silver at these levels to diversify away from dollar reserves. Industrial users need silver regardless of price because modern technology can't function without it. When you hear financial analysts warning about a crash back to $30 or $40, they're assuming the Federal Reserve can tighten monetary policy aggressively to defend the dollar's value. But we just established they can't do that without triggering a sovereign debt crisis. They're trapped, and the floor under precious metals reflects that trap. Now let's talk about the date that should be circled in red on every calendar, February 27th, 2026, first notice day for March. COMEX Silver Futures represents the deadline where contract holders must declare their intentions, either roll forward to future months, accept cash settlement, or demand physical delivery of the metal they've purchased. Under normal market conditions, this date passes without incident because almost everyone rolls forward. Futures markets exist primarily for price speculation and hedging, not physical possession. But these aren't normal market conditions. We've documented the sovereign buyers liquidating dollar debt to acquire physical metal. We've shown the bank accumulation driven by Basel III capital requirements. We've revealed the registered COMEX inventory at crisis levels. Now, all of those forces converge on a single date where the rubber meets the road and paper promises either deliver or default. Here's the scenario that keeps exchange officials awake at night. If just 7% of March contract holders stand for delivery, the COMEX exhausts its registered inventory. Not faces pressure or experiences strain, literally runs out of deliverable metal. At that point, the exchange has exactly 3 options, and every single one of them destroys the current pricing mechanism. Option 1, declare force majeure and cash settle all contracts at the prevailing paper price, effectively admitting that futures markets are a fiction and physical metal trades at a premium to paper claims. This shatters confidence in every commodity exchange and potentially triggers a cascade of delivery demands in other contracts, as traders realize paper might not equal physical. Option 2, allow the spot price to gap up dramatically until enough holders are willing to sell their physical metal to satisfy delivery demands. This is price discovery in its purest form. No artificial caps, no coordinated intervention, just supply and demand finding equilibrium wherever that equilibrium actually exists. Based on historical examples of short squeezes in physical commodity markets, that equilibrium could be multiples of the current spot price. Option 3, somehow source hundreds of millions of ounces of physical silver from secondary markets, private sellers, or government stockpiles, fast enough to satisfy delivery demands without causing a panic. Given that the U.S. government sold off its strategic silver reserves decades ago and current mine production is already spoken for by industrial users, this option exists only in theory. Most likely, we get some combination of all 3. Selective force majeure on some contracts, price gaps on others, emergency sourcing of whatever physical metal can be located at any price. But all roads lead to the same destination, the decoupling of paper and physical silver markets. You need to understand what that decoupling means for your holdings. If you own shares in a silver ETF, you own a claim on metal stored in a vault somewhere, managed by a custodian who may or may not have all the physical silver they claim to possess. If you own futures contracts or certificates or any other paper derivative, you own a contractual promise that increasingly looks like it can't be fulfilled. These instruments might continue to track something called silver price, but that price will become detached from what actual physical metal trades for in the real world. The leverage in this system is staggering when you break it down. According to data compiled from exchange reports, dealer positions, and ETF holdings, there are approximately 356 ounces of paper silver claims for every ounce of physical metal available for immediate delivery. That ratio would be unthinkable in any other market, but it persisted in precious metals because the system convinced everyone that paper was just as good as physical, that delivery was always available if needed, that the COMEX would never allow a default. February 27th tests whether that conviction survives contact with physical reality. Now, here's what you need to know about this $140 to $160 blow-off top we're forecasting. When silver enters that price range in late February, the momentum will feel unstoppable. Media coverage will shift from "this is a bubble" to "is silver going to $1,000?" Social media will explode with moonshot predictions. Retail investors who ignored precious metals for years will suddenly want exposure. That's the blow-off psychology, and it's how every parabolic move ends in euphoria and exhaustion. But unlike previous manias, this one doesn't crash back to the starting point because the fundamental structure underneath has changed. The $70 floor holds because banks need it, sovereigns are accumulating regardless of price, and the fiscal dominance paradigm ensures ongoing currency devaluation. What you get instead is a violent correction from 160 back to 70 or 80, followed by a grinding multi-year climb as the monetary system continues its slow-motion collapse. The smart money recognizes this pattern. They're not trying to pick the absolute top. They're building positions in physical metal that they can hold through volatility because they understand the endpoint, a world where precious metals serve as Tier 1 capital for banks, reserve assets for sovereigns, and the only store of value that can't be inflated away by desperate governments. Think about what this means for your personal strategy. If you're holding paper silver, hoping to time the perfect exit, you're playing a game against high-frequency traders, institutional algorithms, and sovereign wealth funds with information access you'll never possess. Your odds of catching the exact top are essentially zero, and your risk of being caught in a force majeure cash settlement at paper prices is unacceptably high. If you're holding physical silver in your possession, you're positioned correctly for what's coming. The blow-off top creates an opportunity to trim positions if you need liquidity, but the $70 floor means your core holdings maintain value through the volatility. You're not speculating on momentum. You're holding a strategic asset in a world where strategic assets are becoming scarce. And if you're still sitting in cash or dollar-denominated savings vehicles, watching this unfold from the sidelines, you're making a bet that our fiscal situation improves, that the Fed regains control over inflation, that banks stabilize without needing precious metals on their balance sheets, and that sovereign nations decide the dollar remains trustworthy despite its ongoing devaluation. That's a lot of bets to make simultaneously, and every single one of them runs counter to the trends we've documented. The everything bubble that defined the past 15 years, stocks, bonds, real estate, all inflated by unprecedented monetary expansion, is transitioning to what some analysts are calling the everything bust, not because assets collapse to zero, but because the currency used to price those assets loses purchasing power faster than the assets can appreciate. A home that increases in dollar value by 10% annually still represents a loss if the dollar itself lost 15% of its purchasing power that same year. This is the world we're entering, and it is why institutions are repositioning away from paper claims and into hard assets with a track record spanning thousands of years of monetary chaos. Silver is not special because it's shiny or rare. It's special because it's one of the few assets where supply is genuinely constrained by physical reality rather than by what central banks decide to print. As we approach February 27th, the narrative battle will intensify. You'll hear that silver is overextended, that fundamentals don't support current prices, that this is just another speculative frenzy destined for tears. All of those warnings will come from institutions that need you to sell, that need exit liquidity to close out positions they never should have opened in the first place. Don't give it to them. The 1980 crash was engineered by changing the rules of a paper market to crush leveraged speculators. The 2026 reset is being driven by the physical constraints of a market where paper claims have multiplied far beyond the underlying metal, and institutional buyers won't accept cash settlement. These are not equivalent situations, and pretending they are serves only those who need you confused and afraid. Our banking system is sitting on 356 paper claims for every physical ounce. Our government is spending $1 trillion annually just to service debt that keeps growing. Our central bank has exhausted its liquidity buffers and entered fiscal dominance, where deficit financing takes precedence over price stability. And our sovereign competitors are liquidating dollar reserves to acquire the one asset that preserves purchasing power across currency regimes. The calculation is complete. The forensic evidence is overwhelming. The deadline is approaching. What you do with this information determines whether you exit the system holding claims on value or holding actual value itself. Choose wisely, because February 27th isn't coming with a practice round. The $150 reset isn't the end of the story. It's the beginning of a new chapter where physical possession determines wealth preservation, where paper promises reveal their true worth, and where the financial system's leverage finally meets the immovable object of physical scarcity. Welcome to the other side of the monetary looking glass. The map you've been following no longer matches the territory, but at least now you know why.